So many of you have been asking about my opinion on Shopify. And Shopify actually, recently missed on earnings big time and they gave gloomy guidance. And the company said that inflation and interest rates would weigh on consumer spending. And it's also laying off 10% of their workforce. Now, in that kind of news, you may think Shopify went down like, 15, 20%, or even 40% like Snapchat. But no, actually, Shopify went up on that news from $31 to $35 a share. And this is what we're having right now. We're having some stocks go up on bad earnings. And of course, this is not something that's sustainable. But you could actually see the trend. More and more companies are saying that interest rates and inflation are weighing on consumer spending. And this is not getting better. This is only getting started. And they're laying off 10%. Many other companies laid off 10%. But essentially, let's look today at Shopify stock. Many of you are familiar with the business model, so I'm not going to go into it and waste your time. I'm going to focus more on the fundamentals and determine if Shopify is a buy right now, or if it's maybe you should wait on it a little bit more, as the stock is really, I believe, down over 81% year to date. So that's a pretty big down move. So let's take a look at Shopify. The big thing with Shopify that I don't like is if you look at the gross profit margins, they have been going down steadily from 56% to around 50% recently. Now, why are those margins going down? For two main reasons. The first one is Shopify is trying to kind of expand in many other things, which has some positives and it has some negatives. For example, they have Shopify payment, Shopify capital, Shopify shipping, actually logistics and stuff, which is very low margin. Shopify Plus and Shopify Balance. Now, those things have lower margins and they don't really are as profitable as the subscription revenue that Shopify actually gets. But I get why Shopify is doing that. It wants to be a one-stop shop for any business. And it kind of has a moat around this, mainly because if you're a business and you actually use Shopify and then you use Shopify payment, you use Shopify shipping and all kinds of stuff, it's pretty hard to move and go to someone else. So this is something pretty smart for the very long term. But again, this really is waiting on the margins. And we could really see it in the Q2 earnings report. And you could look at the subscription solutions, they went up a little bit on the revenue, but the main revenue growth came from merchant solutions. And if you look at the cost of revenue, you could see that for 928 million, it costs them 554 million to get this type of revenue. It's much higher than, the 85 million that costs them to get 366 million. So the merchant solutions have lower margins than the subscription solutions. But again, I mentioned why Shopify is doing that. I think it's a pretty good move for the long term to establish more of a moat around the business. So the business can't really leave. It's not so easy to go and go to Wix.com or any other website, which is pretty smart. But again, despite all of that stuff, they made a little bit more in gross profits, but they ended loss on operations 190 million down. Now, I do really like the growth that they got in the merchant and subscription, but what makes me think that maybe this growth is basically coming only from marketing. Meaning if Shopify slows marketing, the income is gonna slow a lot too. Look at research and development, it almost doubled. That's pretty big. So Shopify could have been actually profitable this quarter if they didn't overspend on research and development and sales and marketing. But this makes me think that this growth is gonna slow down if Shopify doesn't keep spending. Therefore, the business model may actually be never profitable unless they were able to get so much revenue growth, which I don't think they will be able to get in the coming years. The business cannot be profitable, mainly because if Shopify doesn't, spend on R&D and doesn't spend much on marketing, the business is not really gonna grow a lot. So I ended up with I believe, a $1.2 billion loss of net income, which again has to do, with some, income taxes and other expenses and a couple of other things. But again, focusing on the business itself, the company is still not profitable. And if I was the management team, I would not be going all in right now. I would be taking things a little bit more slow, a little bit more responsible, so I can at least have a steady trend line of me becoming profitable. When I look at an unprofitable company, I want to see it going from negative slowly to positive. But Shopify is doing the opposite, and this is something I don't personally like. But now I'm gonna take a look at my valuation model to determine if Shopify is actually a buy or if it's maybe too expensive and we should wait for another price. So this is my valuation model on Shopify. The analysts are expecting 30 to 35% revenue growth over the next 5 years. I personally don't think it's possible. I think it's too optimistic. So I chose a more lower number, which is 25%, and they may not even be able to hit 25%. But I believe they maybe can do, as the TAM is huge. So let's assume they hit the 25% revenue growth. That would take them from around 4.6 billion in revenue to 14 billion in revenue in 2026. Their net income right now is around 691 million, and their net income margin is 15%. Again, I chose the same net income margin mainly because, the merchant solution is increasing, which has a little bit lower margins. So same 15% would be around $2.1 billion of net income normalized. So looking at the PE ratio, Shopify now, the PE is extremely high. But I chose a PE of 40, and I think this is very optimistic. I think, 25 to 30 would be better for Shopify 5 years from now. But again, it has so much TAM that I could keep the 20% growth maybe for the next 5 to 10 years. So this is why I chose a little bit of a premium with a 40 PE, just to be fair with the valuation and with the growth that Shopify has. So again, using a optimistic 40 PE with a $46 billion market cap right now, you get an $84.4 billion market cap in 2026, which is only an 84% upside over the next 5 years, or only 13% compounded every single year for the next 5 years. And to me, basically, looking at my valuation model, I don't think I'm missing anything. I don't think the revenue growth is going to be higher. I don't think it deserves more than a 40 PE. I'm not going to use a 100 or 200 PE. And I'm not going to use price to sales in this environment. And with the economy slowing down and the company itself mentioning that consumer spending, it's waiting on it, and it's not going to get better, it's going to get much, much worse. So I believe all my numbers are fair. And according to my model, Shopify is not a buy right now yet. If you could maybe get it for at least around the maybe $40 billion market cap, you could at least double your money over the next 5 years. And if the PE ratio ended up being above 40 or the growth was higher, this is a plus. But if you can make some kind of a conservative estimate and you could at least double your money over the next 5 years, this is one I personally buy a stock. In case of Shopify, it's not a buy right now. So this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.